Let's bring you all the business news now. And first up, we bring you an exclusive conversation with Akasa Air's CEO, Vinay Dubey. The airline has taken to court the pilots who left without serving the mandatory notice period. Why has the airline taken such a step? Vinay Dubey clears the air on the issue. Listen in.
First and foremost, this rule that requires pilots to have a contractual notice period has been around for, maybe 15 plus years. And this was a civil aviation regulation that our regulator came out with, I think it was 2006. And so this has been around. This is not anything new. This is not related to new demand, new pilot shortage, nothing. This has been around, like I said, since 2006. Now, it's also important to understand why this rule was put in place by our regulator. And for that, I'll take you back to an unpleasant time, which we'd all like to forget, when we were locked up in our societies, in our buildings during COVID times. You'll remember that. And the people that were actually allowed to leave the buildings were people in the medical services and hospitals and nurses and doctors, or people, police and fire and ambulance, those kind, and airlines.
Journalists as well.
Journalists as well.
Okay.
Journalists as well, right?
Yeah.
So there were people that were termed essential services. They were so important to nation building, they're so important to the running of the country, that they were termed essential services. And pilots are an extremely important element of the airline. And it's with that background that this rule has been created. Because if a pilot leaves, calls you at 10 o'clock at night and says, sorry, I'm not coming tomorrow morning, it is extremely disruptive. And you leave passengers stranded at the airports. And so it's with that background that these rules are put in place. And it's not just for Akasa, it's for our customers. It's for the fact that customers shouldn't be left stranded.
Markets extended decline for the third straight day. Metals, PSU banks and consumer durables rose, whereas pharma and realty sectors were under pressure. Mathew with a wrap of all the market action.
All right, so equity markets beginning the trading week on a tentative note, and this is in line with what's playing out globally, with risk assets across the board on the back foot at the start of the week. And this is probably on account of the worry that the conflict between Israel and Hamas will extend to other geographies, and that could have implications across the board. Paying close attention to what happened in trade today, you had the Nifty 50 trade in a very narrow range of about 90 points or thereabouts from the high point to the low point of the day, and ending with cuts of just about 0.1%. In fact, the broader markets outperformed, and that was only to a very narrow extent. So both the mid-cap and the small-cap index ending with very narrow gains. HDFC Bank results were eyed. It was widely expected that the bank would post its results for the second quarter during market hours. That hasn't panned out. And in fact, it's expected that it's going to post a weak asset quality as well as a deterioration in net interest and margin, and we'll have to see how that pans out. The Nifty Bank as a whole ended just marginally lower, and the outperformer today very clearly was the metal index. Among the top performers on the Nifty 50 then, you had JSW Steel as well as Tata Steel, but the top gainer was Hero MotoCorp. A couple of other gainers as well, the likes of Coal India and LTI Mindtree gained ground. Among the losers, you had Divi's Laboratory, that was the worst performer, down over 2%, and then Nestle, TCS, IndusInd Bank and Asian Paints were the biggest losers. HDFC Bank, as I mentioned, lost about 0.4%. Gati was one of the stocks of the day, gained over 10% as its July-September cargo volume grew as much as 18%. Delta Corporation dropped another 10% or thereabouts after a unit received a GST demand notice of over 6,200 crore rupees. And finally, I will mention Avenue Supermarts, which lost about 4% at one point because its PAT for the second quarter missed estimates. All told, tentative start to the trading week. We'll have to see if this pans out over the course of the remainder of the week.
Guidance cuts and slowdown in revenue growth have crippled the Indian IT sector. In the middle of such a conundrum, how should an investor gauge the risk factor in the sector? Here's Old Bridge Capital's Kenneth Andrade with an overarching view.
These are fairly mature businesses and they are large. Okay, and the contract values that they are getting are also significantly large. Okay, and either which way that we look look at it, these are all cost takeout issues, and they are fairly and they've got a social implication for it in the West also. So while the order books look large and everything looks fine, I think you got to pace this environment a little bit. It's going to move slower than you expect it to be. Right. And all these businesses used to be fairly well priced. Okay. And if we ever get to the point where we get a sell-off, okay, I think top of your entire matrix, top of your entire buy list should be these large IT businesses. Because it very rarely, at least in the India context, you see such large cash flow generating businesses available at yields which are this high. So I wouldn't play this industry for growth. I'll just look at it from a cash flow yield point of view, because assuming that these companies can grow at 20% is not the right way to think about it.
India's largest private lender, HDFC Bank, witnessed strong growth in the second quarter, with net profit rising nearly 51% year-on-year. This is the first quarterly earnings by the lender after the $40 billion mega merger with HDFC Limited. Net interest income for the bank rose 30.2% from last year, but the asset quality for the lender worsened. The festive season brings cheer for the logistics company GATI. The stock zoomed over 14% intraday as pre-festive orders drove quarter two volumes. Meka Bharve joins us with a full analysis.
Gati rose over 14% in trade today as the company reported its monthly update for September 2023. The total volume, including surface and air express, now stands at 109 kiloton, and this was an 8% increase compared to September 2022, but a 3% decline compared to August 2023. The growth momentum continued despite a high base in the same month last year. The company's volume for quarter two FY24 now stands at 333 kiloton, which is an 18% rise year-on-year. This was due to strong pre-festive ordering, and the company expects this momentum to continue into October 2023. It also reported that the Bengaluru transmission hub is now fully online. In terms of stock performance, the stock is down 1% this past month and 8% in the past year, but it's up 13% year to date. According to Bloomberg, all the three analysts tracking the stock maintain a buy rating and have stated a 12-month return potential of 24.8%.
The rise in UPI transactions has brought a limelight back on no MDR on UPI regime. As the volume of transactions increase, should a merchant be charged MDR for UPI payments? What do experts have to say? Pragati Oberoi with the details.
Do you make payments via UPI? Has it ever struck you that it is free and that there's no MDR on it? The recent rise in UPI has increased the conversation around the very idea of free UPI, but for how long? In September, UPI touched another milestone when the number of transactions crossed 10 billion for the second straight month. The interesting bit, it was on the back of a rise in person-to-merchant transactions or P2M. They grew faster than person-to-person or P2P transactions, according to a Worldline in India report. Experts that BQ Prime spoke to said that this growth can be due to various reasons, like zero transaction fees, increased acceptance by merchants, and even due to the increased use cases of UPI. But with the UPI ecosystem developing, investments and rising costs come as naturals. And this is where the entire conversation heats up. To put it simply, an MDR is a fee that an issuer bank charges a merchant for accepting credit card and debit card payments from the customers. Since the onset of the COVID-19 pandemic, RuPay debit cards and UPI payments don't attract an MDR. But the experts that we spoke with were largely divided. On one hand, some said that the UPI ecosystem is developing in such a way that now payments need to be compensated, and hence a nominal MDR will help cover the running costs for the payments business, if not make it profitable. On the other hand, others believe that free UPI is here to stay, as the derived benefits of a zero MDR policy far outweigh the compensation or the costs that are incurred.
And that's a wrap of all the business news.